Hey, if you've been watching the markets lately, you've definitely seen the wild swings. I mean, the volatility has been completely off the charts. It all seems so chaotic, right? Random even. But what if it isn't? What if it's all connected? Today, we're diving into a really compelling theory that links all these geopolitical events to the madness in the market, suggesting it could all be part of a much larger, coordinated strategy. So let's start with a central, almost unbelievable question. Can the United States, with its military stockpiles at historic lows, actually rebuild its arsenals without help from its biggest global competitor, China? The answer here? Well, according to the source we're digging into, it's the key that unlocks this entire puzzle. And that brings us to what the source material calls the China paradox. It's this baffling, puzzling dependency that honestly just seems to defy all logic. I mean, think about it. A nation actively arming its main rival. Let's take a closer look at just how deep this reliance goes and why, just starting up domestic production isn't something you can do overnight. Okay, first up, tungsten. This stuff is absolutely critical for making military-grade penetrators, for armor-piercing weapons. And get this, a staggering 80% of the US supply is sourced directly from China. Building a new supply chain for that would take years. So without China's supply, a key part of the US arsenal simply can't be produced. Period. And it gets even crazier. With gallium, which is essential for manufacturing the GPS chips that guide all our modern weapon systems, well, the dependency becomes almost total. Here, the United States relies on China for 98% of its supply. That's not a dependency, that's practically a monopoly. And the list, well, it just keeps going. For germanium, which is vital for the infrared seekers in missiles and advanced surveillance gear, 60% of the supply comes from China. Without these materials, the US defense industry would just grind to a halt, which really makes you wonder, why on earth is China providing them in the first place? So yeah, this begs the obvious question. Why would China, a nation that seems to be disadvantaged by recent US foreign policy, keep supplying the very materials needed to power the US military? Well, the source material we're looking at suggests this isn't an accident. It's a pasdelio, a Spanish term for a prearranged deal, basically implying that these moves were all negotiated behind the scenes. This whole idea of a pastello, a backroom deal, leads us to the next massive piece of the puzzle, the recent closure of the Strait of Hormuz. The move that sent total shockwaves through global energy markets. So the question is, was this some kind of surprise attack, or was it a perfectly timed, calculated event in this global chess game? Let's just walk through the timeline and see how all the pieces seem to fit together. So, according to the source, the US moved first. It secured oil flows from Venezuela to make up for a future planned disruption. Then, the bombings in June served as a signal that China clearly understood. And how do we know they understood? Because right after that, China took its oil, gas, and coal reserves to their absolute maximums. They knew exactly what was coming. And then bam, the Strait of Hormuz was closed, just as planned. In any situation like this, the most important question you can ask is always cui bono. It's Latin for who benefits. And when you follow the money and the power, this theory we're looking at suggests two major winners emerge from all this orchestrated chaos. The first clear beneficiary is Russia. The disruption in the Persian Gulf plays directly into Moscow's strategic playbook and their economic interests. It created the perfect opportunity for them to boost their influence and their profits, all while just staying on the sidelines. Okay, so here's how it works for them. With Middle Eastern supply lines all choked up, China is forced to look elsewhere. That leads to more energy purchases from Siberia, and suddenly a major Russia-China gas pipeline project is back on the table. At the exact same time, higher global oil prices mean a massive revenue boost for Russia, letting them shore up their public finances. Russia stays quiet and just rakes in the profits. But the primary architect and the main beneficiary of this entire operation, according to this theory, is the United States itself. Now, that is a bold claim for sure, but the argument laid out is actually pretty compelling. For the US, this was like a multi-pronged strategic victory. First, Asian nations cut off from their usual LNG supplies from Qatar are now forced to buy more expensive liquefied natural gas from the US. This immediately increases the world's energy dependence on America. But hold on, there's another, much more subtle play here, and it involves fertilizers. Just think about this staggering fact for a second. 1/3 of all globally exported fertilizers pass through the Persian Gulf. By controlling this choke point, the US can disrupt the supply to Asia, especially to a huge agricultural nation like India. This creates a food security crisis that can only be solved by, yep, you guessed it, buying US agricultural products. It's a masterclass in geopolitical leverage, turning a military move into a powerful economic weapon. Okay, so how does this grand geopolitical strategy circle back to the crazy volatility we're all seeing in the stock and commodity markets? Well, the answer, according to this analysis, lies not in the physical supply of oil, but in the world of high finance. This quote from the source material is really the key to understanding the market's wild reaction. The huge price swings weren't driven by a real long-term shortage of oil barrels. No, they were driven by the financial markets, by something called paper oil. So let's quickly clarify what that means. Physical oil is the actual stuff, the barrels, the production, the reserves, the tankers. The disruption here is seen as a temporary tension. Paper oil, on the other hand, is the world of financial derivatives, futures contracts, options, and massive short positions. Think of it like a giant casino where people are betting on the future price of oil. When the Strait of Hormuz closed, a lot of players who had bet the price would go down got squeezed and were forced to buy, sending volatility into absolute overdrive. And this chart really puts it all in perspective. The recent spike in the Oil Volatility Index, or OVX, actually shot past the levels we saw during the 2008 financial crisis. This just shows that the market's reaction was a massive, historically significant shock to the system, and it was fueled by these financial mechanics, not just a simple supply and demand issue. So what is the end game here? What's the final play? Well, according to this theory, the ultimate goal is for the United States to establish permanent control over global energy flows. And why would they do that? Because in the 21st century, energy is what powers data centers, and data is power. By making energy more expensive for its competitors, the U.S. could slow their progress in the one race that truly matters now, the global battle for dominance in artificial intelligence. So, what does this all mean for the stock market? Well, the analysis concludes that since the main geopolitical objectives have now been achieved, this whole oil shock can be seen as temporary. And despite all the uncertainty, the markets are holding up remarkably well, showing incredible resilience. This suggests the volatility we've seen isn't a sign of some deep underlying weakness, but maybe just a temporary reaction to a very well-executed plan. Which leaves us with one final, pretty thought-provoking question. As you watch the daily market movements, you have to ask yourself, are you witnessing the unpredictable fallout of total chaos, or are you just watching the next scene in a carefully crafted, globally scaled script? And if it is a script, who's writing the next act?